From the morning reading, the spider pauses and pulls back on light volume. 2 of 9 sectors moved higher on Monday. XLV and XLP and XLK were the strongest sectors, while XLB was the weakest sector. Oil futures fell $1.17 to close at $35.46. Breadth weakened as decliners led advancers 1.36 to 1 on the New York Stock Exchange and 1.87 to 1 on the NASDAQ. Over the past year, trend persistence has taken a big hit. A year ago, the strength of stock's long-term trend was at a near record level and has since dropped back to the lowest since 2012. That has been a negative signal in the past, preceding several large declines as stocks corrected to become less glued to the long-term trend. The S&P 500 is nearing fair value. According to Wall Street strategists, the S&P needs to add fewer than 90 points before it meets their price target for 2016. When stocks have been fairly valued in the past, they have tended to provide subpar returns. Even while individual investors say they are worried about stock prices, they've been reducing their cash pile. They held an average of 18.5% of their portfolio in cash last month, down from more than 21%. Still, that's just a bit below average for the past 5 years. Stocks have had more trouble when their cash position dropped below 18% at least. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:47 a.m. Central Time, and I am recording this in preparation for the market day of April the 5th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. All right, let's go ahead and dive into the morning report, and we've gotten some action last night. S&P futures were down at the time of this cut about 14 points, or about 0.2%. Russell even more so, approaching 1% drop. NASDAQ down a little over 0.5%, as is the Dow futures, also a little more than 0.5%. Crude oil essentially scratched. Euro down about 1/3%. Bonds up about 0.75%, and gold up over 1%. In overseas action, also pretty active. China up about 1.5%, but Hong Kong going the opposite direction, down about 1.5%. Japan down nearly 2.5%. Germany down about 2.25%, and United Kingdom down 1.33%. In terms of macroeconomic reports for today in the United States, we have trade balance, non-manufacturing PMI, and JOLTS job openings. And then looking forward to tomorrow, we have the weekly crude oil inventories, also FOMC member Mester speaking, and then the FOMC minutes. So that certainly can be a big impetus to action. So be aware of that coming up tomorrow at midday. In terms of current conditions, in terms of volatility conditions, short-term VIX came up a little bit yesterday with a little bit of weakness, though it was on low volume, kind of shallow weakness thus far. Now, obviously, with last night's overnight, we might start to see something get ahead of steam. That's a potential. Short-term VIX is at a 12.5. The skew right on the threshold of where we call it in warning status. IV percentile for the S&P, a very, very low, 13 RUT or Russell. The is an 18, the NASDAQ a 13, the Dow a 10. No standard deviation moves were put in on a close-to-close basis on any of the 4 U.S. broad market indices yesterday. Also note that in the last 2 trading weeks in the S&P, we've had 2 standard deviation moves, so that is much lighter than normal. In fact, if you look across all 4 of these, even the Russell, very, very light in terms of the number of standard deviation moves. So been pretty calm here of late. In terms of the charts, let's go to the charts. So here's the S&P, and you notice we've got this kind of long-term trend line, also this area of swing horizontal resistance, and we're looking at this area right here as an area or zone of resistance as multiple things kind of start to come into play. And you have this horizontal, this horizontal, this horizontal, and then these horizontals all coming into this area where the former highs were. And there's going to be probably a lot of fight for the bulls to be able to get through that. Remember, each time the bulls tried to come up to this area in the past, it failed to get through. So the question will be on everybody's mind, including the institutions, is can the markets get beyond that? You notice one of the morning readings was talking about the Wall Street strategists and that the S&P only needed to add about 90 more points before they meet the price target for 2016, at which point the Wall Street strategists think that you have fair value. So in terms of the likelihood of being able to get much more than about another 90 points on this, becomes problematic. And our pot odds start to drop versus the potential for movement to the downside. Now, that doesn't mean that it's going to happen that way. Certainly, if we were able to get through that area and punch out for new highs, you can see us turn around in a very short period of time and be up another 100 points. So the question is can we beat our way through this band of resistance, and what does that open up? If we fail, then of course we expect, frankly, more ranging type action, much like we've had in the last 18 months now. In terms of the Dow, not very different looking than the S&P, very much in the same kind of relative area. The Russell, looks like it wants to at least consolidate in a sideways pattern. Now, in the last couple times it did that, it did move higher. So we had really no retracements during this move. Then we had these short several day consolidation patterns, and then a break higher, and then a consolidation, and then a break higher. So it's still in a bull flag pattern, but it seems to be starting to run into some more difficulties as it's come up towards its long-term trend line, which isn't that much further above us. We'll call it about 1130-ish, depending on how fast it would get there. So if your highs have been around 1120, it's got about 10 points left before it runs into significant resistance areas. Now, of course, if we go to the futures, we know now that the futures have us as coming back down, and you see now we've got a Pearson's arrow to the downside, could be pointing to something, a bit more of a pullback. Now, you notice the last several times we've had these down arrows in the Russell, it very quickly reversed. So we'll watch this to see where this goes. It's still a bullish pattern and just setting up a bull flag continuation pattern until it violates all the way down to 1060. So it's got a lot of room to drop before it even does any mild technical damage to the intermediate term pattern. We were stalking the potential of some volatility plays yesterday, and we may have missed our opportunity. We'll have to see how this plays out. We were toying with the VIX at just below, around the 13 level, and we're wanting to put on some positions with the volatility products. And looks like we may have, at least for today, ticked up. We'll see if that ebbs back off and gives us, again, an opportunity. Volatility, though, has been the lowest it's been in a very long time. You have to go back to really last summer before you saw that volatility was much lower than it is currently. If you look at the regular VIX product, you'll see even better what I'm talking about. So you tickled below the 13 level, and you see this area has been a support area for volatility in the past. And then before that, you did get down here into the 10 handle, 10 and 11 handle last summer. And look at that. So the low, you hit the low at 10.88, and then not 2 weeks later, you're up here at 53. It's amazing how that low levels, doesn't seem to persist before you start to see that expansion and volatility. And that's kind of what we're looking for with those volatility plays that we're stalking in the trade room at this point. Let's see, gold. Gold was kind of tickling with this diagonal resistance area, so continue to watch gold, especially if the equity markets start to break down. That could be the impetus, the flight to safety with gold could see some action going that direction. Okay, and then bonds. Let's see if bonds are telling us anything. Well, I think bonds are telling us something. Look at this. Breakout above the cloud. So this is what they call a cloud breakout. You also have the Chicow line as cleared price action. So this is a Chicow breakout as well. So a couple different kinds of signals here for followers of the Ichimoku cloud. Each one of those firing off a bullish entry at this point. And if gold were to get clear of this area, you would expect that it would run up at the very least to the 168 area and then perhaps beyond. So that's certainly of interest. I should say bonds. I say gold there. Bonds. So if bonds get going here, that certainly says something about what the equity market is likely to be doing as well. So we're starting to see some signs from volatility reversing, from the bonds reversing and clearing out, and then also from some of our equity markets starting to potentially fire. Here's another on the S&P futures, another Pearson's arrow giving us a sign that this pattern has reversed. So some early signs here. We'll see if we get follow through and confirmation and just how far this goes. But some early signs here that we might be seeing something of a retracement pattern set up. Now, this is just a retracement until proven otherwise. It's expected to be a bull flag and a relatively shallow pullback until we get proof of something larger. And let's go to our daily report. And not much change from yesterday. We're still phase 4 with our market trend, intermediate term phase opinion, price patterns near horizontal resistance. Our 3 market timing signals are all very nicely in the bullish camp for the vast majority of those signals. IBD has confirmed uptrend. The other market timing signal, GMI index, a perfect 6 out of 6. Stock charts is the only one that's got anything in the ointment, as it were, because it's short to intermediate term are stacked nicely in the bull camp, but they're up against the face of the long term, which is still bearish. Also note that our accumulation distribution scores have improved to both on the S&P and the NASDAQ to a B-. So those have finally come off of their warning status. Position sizing opinions remain at 100%. Market posture on the intermediate term for all 4 of the indices are extremely high. In fact, they're all above a 96. So very little room actually for them to get much stronger. So very, very strongly bullish with a weak but supporting bullish sentiment line. In terms of the strength of the trend, currently weak but significantly improving. We're still below that 80 line where we would call the intermediate term bull trend strong. Hedge warning status is still a 0+, normal with some elevated conditions. And you see in terms of those elevated conditions, not much, just the volatility ratio warning. It's been firing multiple days now. And we have the intermarket risk aversion indicators all have rolled as several days ago now as risk off. In terms of sentiment, we have medium term high sentiment on stocks. And then in terms of individual symbols, only LQD. In terms of special opinions, no changes from yesterday. We're still saying that conditions are acceptable for option income strategies, cover calls, and put selling. And and becoming more aggressive with the ratios. So you see here only 1 to 2 of in the money versus out of the money strikes for covered calls, a 1 to 2 ratio with low beta versus high beta. So if indeed this proves out just to be another bull flag, it's an opportunity to perhaps set up some new positions. We'll watch and see if it does anything more. Back to sentiment, our fear and greed index up here near the upper quartile with a 74 as the cumulative sum of the 7 fear and greed indicators. And you see yesterday was a 77, so it dropped just a tad. In terms of the intermediate term market posture across the various markets, you do see one new signal came in yesterday, crude oil term, intermediate term bearish. That was a change with yesterday's action. And you still see a large, broad cross-section of intermediate-term market postures across both defensive and non-defensive sectors and ETFs. So it's a fairly broadly supported market at this point. In terms of percent change, you see some weakness did come in yesterday across several sectors: transportation, energy, industrials, materials, retail, all weakening in their short to intermediate term market postures. The ones that are holding up the best so far, certainly a pretty heavy representation of defensives. You've got consumer staples, you've got utilities holding up across all the different time frames, but there's still in telecom. So we'd have 3 that we would call kind of the defensive plays, but you also still have some higher beta. You see here 1.08 consumer discretionary, slightly higher beta. Technologies only a 1.01. So it would look, if you look here at the higher betas, they're the ones that came off. Yeah, see all the higher betas. There was rotation out yesterday is essentially what happened. Rotation out of the higher beta and holding up in terms of the more defensive kind of locations. There was one interesting subplot yesterday going on with the healthcare. We've been talking about how biotech has been hurting both the healthcare sector as well as the NASDAQ 100. Well, biotech's been coming on pretty strong in the last short period, and you see this reflected in yesterday. It was the hero of the day with up 1.02%. So I think that's probably enough for today. Let's go ahead and do our wrap-up sequence. And let's talk a little bit about the room. I don't talk too much about my own room, but we do have a live trade room where we put all these trading principles into live practice. If you'd like to get more details about this, just go to that website address. It's a very good value at only $50 a month to be able to get access to all the regular room and member features. We have 3 different core portfolio strategies, and certainly we model all 3 of those. Yesterday actually was rotation day on our quarterly plan using ETFs. We also use dividend aristocrats in a strategy, and then in a IBD top 50 strategy as well. Option income strategies, including what we call our mortgage strategy, swing trading using options often, and then also a number of other smaller strategies that come into play. I think I mentioned earlier in this video about how we're stalking some volatility plays and some hedging plays with this low volatility. So it's a complete portfolio management using both stocks, ETFs, and option plays to be able to manage our portfolio. Very comprehensive approach with all the various tools, all for only $50 a month. If you're interested, just go to the website there. You'll see a place to sign up, and we'll get you started with a 2-week free trial, let you take a look at that product. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. You notice the hyperlink at the bottom for the full set of disclosures. And we'll see you back here tomorrow morning for the Falcon Global Market Preview. Good trading.